Hey guys, it's Chad Larson with MLD. This is a special kind of a segment of MLD Money Matters. For the reason we've got Greg Taylor in our offices today. I don't have a podcast studio, so he's just down the hall from me. But Greg was in town, and I thought it would be a great chance to introduce him. By a bit of way of background, Greg Taylor is this chief investment officer at Purpose Investments. So first off, Purpose Investments has been around for over 10 years. There's over $18 billion of assets under management. And MLD has had a formal working relationship with Purpose over the last 5-6 years, and going back into the augmentation of my career. In that, the formation of MLD Core Fund, which is, part of the recipe or building blocks of creating our core portfolios across client accounts. Greg is part of the formal informal investment selection committee. Is someone that I speak to on a regular basis, and helping formulate, confirm thought processes, polish up investment thesis, looking for opportunities across the marketplace. And we leverage the other institutions and managers that we sub-employ and work closely with to help drive client outcomes. Listen, we're going to thank Greg for being here. He's a data-driven manager with a focus on managing risk through active trading strategies. He specializes in finding and exploiting pockets of volatility in the markets to drive returns, and he spent more than the last 15 years managing pension mutual fund assets. So Greg, first, thanks for being here. We did spend a couple minutes in the side room before we went to filming and saying, what are we going to talk about? And we're going to keep this quite informal. One of the things I'm going to tee you up to start about is it's only been 2 weeks less than my kind of last segment, where we talked about the narrow breadth of the market, some of the concerns as we enter into a recession. And I did guide clients that, because the markets are forward looking, but just to remember from the armchair of your living room when you're watching the news, like, the data is probably going to get bad. But we have this seasonal Santa Claus rally. Like, is this bounce real? Tell me how you're seeing things, what your peers and colleagues, and how you're doing through this.
Yeah, thanks, Chad, and good to have on the podcast. I know you've been a big supporter of Purpose, and happy to help in any way and can, and also, just as you mentioned, keep the conversation going, because it's a two-way street, and I think you can never have enough information in this business. Always good talking to smart people that are connected, and talking to those people. I think the question you just asked is by far the biggest question everyone's getting right now: is this bounce real? And it's always one of those things you never know till the end, but I think it goes back to just positioning as much as anything else. That going September, October, which we all know was the seasonal bad part of the calendar, there's a lot of issues, and they played out. Seasonality has actually been working really well this year. So September, October were pretty dire months, and really what happened in October is, outside of the problems in geopolitics in the Middle East, the biggest issue is that bond yields took off. And this market's really coming down to one factor, and it's all about bond yields. And when you look at just looking at the 10-year US bond, it really started to scare people in the middle of October. It took off. The 10-year went back to well over 5%, so near cycle highs. And that wasn't supposed to be the case. Everyone thought that yields had kind of peaked out in June. And when they spiked higher in October, that caused a lot of panic. And we saw that in equities as people kind of threw in the towel, with banks going down, REITs going down, retailers going down. And that was kind of an ugly period as people started talking about the hard landing. Did the Fed lose control? And it kind of one of those darkest before the dawns. And then it's just kind of magically, and I'm going to have to remember this next time, but as soon as the calendar flips, magically you go from the worst 2 months to the best month of the year, which is November. And I was looking at it, that November really started off with a bang. The numbers came in well. Bond yields started to pull back as we got some weakness in inflation data. And the first week of October was the best week that we had in the calendar year. And again,
the markets were up in that one day. They were, what did the TSX rally that one day? It was well over 2. It was like 2.5.
It's 2 or 3. And it's really interesting, just the tone that shifted, because And it's also, when you look at some of the sentiment indicators, they got really washed out. There's a good survey, the AAII Bull Bear Index, comes out every Thursday. They just survey different advisors throughout the US. And it's a simple question: are you bullish, bearish, or neutral? And the amount of people that were bullish in the end of in November, sorry, last week, October, we're almost at the all-time low. So people were just giving up. Looked at it, it came out last week, back to almost the all-time high.
Isn't
So the
that
biggest,
almost, isn't it,
swing from sector.
pre-doing the podcast, one of the, call it the graphics, like, I think a lot of times people like you and me start talking about treasury yields and job numbers and non-farm payrolls, and people's like eyes glaze over. Even mine do. I just have a better attention span to pretend I'm interested in stuff because I have to and I'm paid to. But I used to and I still look at it as that Yahoo has a great fear and greed index. And it was quite interesting. It's almost like, do the opposite. And it goes back to that Warren Buffett, be greedy when people are fearful, and be fearful when people are greedy, because when everyone is done selling, what's the only thing that can happen?
Yeah, there's no one left. If there's no one left to sell, the market's going to go up, and that's kind of what happened. I started out my career on the buy side, but as a buy side trader.
Is that enough? Is that enough a reason, or only for tactical parts of your capital? Like, if the only reason something's going up is because it's being thrown out a window, is
no, but it's also kind of just a start. Like, some rallies have to start from somewhere, and I would be in the camp that this rally we're seeing in the last week or two is more of a seasonal tactical short cover than anything else. I don't think this is the start of a new bull market. As you mentioned, there's going to be a lot more bad news coming ahead of us. But I think for some sectors, I think we probably have priced in the worst case scenario. When you look at some parts of the market, again, looking at the value tilted, the banks, the utilities, some of the telcos, they've priced in almost Armageddon. And anything less than Armageddon, you're going to see a bit of a bounce here. So I would say there are parts of the market that are still a little stretched. We've seen some mania in the AI hype. NVIDIA's been a fantastic stock. It's a great company. It might be a little expensive right now, because I don't think everyone's going to be putting an AI server chip in their backyard anytime soon, which is almost what it's pricing in. But things are going to sort out, and I think you're going to see a bit of a normalizing. So I do think we're in the camp that there is going to be recession next year in the US. The debate is whether Canada's already in one, which is an academic debate anyway. But again, markets are forward looking, and markets tend to bottom 6 months before a recession. So if people are talking about a recession happening sometime mid next year, you can say we price that in, and we're going to start to see things start to get a little better. And the equity markets might be the forward leading statement. Equities are supposed to be forward leading, and I think we can have priced in a little bit too much downside.
Yeah, we talked about that calendar flip too. It's almost kind of funny when the minute we wake up January 1, Lord, probably with a headache for most of us, we can start talking and pointing to 2025. Like, I think one of the interesting stats that I was looking at is, we talk about like the equal weighted S&P and how narrow the market returns have been, stripping out the Magnificent Seven. This is such an industry filled with acronyms and taglines, but it's how we sell newspapers, right? The equal weighted S&P is down. The TSX is meh. Banks have been decimated. This would be net of technology stocks in this AI hype. Third time in history the S&P would be down 2 years in a row. No, listen, we're doing something more than betting, and I think reversion to mean is such a dangerous thing to anchor, and it can be part of our process. But the reality is, and I tried to make the analogy, and again, no one's going to get tarred and feathered for this. But are we in the seventh inning of this? Are we in the eighth and ninth? I can say with some certainty of my personal belief, and I'm sure all the small print at the end and the disclaimers that these aren't the views of all people. But the worst of this is over. Do we get our cages rattled one more time? But this is, I have to believe that with the yield curve being so inverted, 5-6% GIC, wonderful, taxed very inefficiently. You can't stretch duration out. And 2 years out, equity markets look a lot more constructive. Sorry, that was my phone.
I turn it around a little bit, because I think the biggest thing that we can maybe say we are in the eighth, ninth inning of is the move in bond yields. And I think that's been the big thing, and it's been the biggest factor for everything from real estate to fixed income to equities. is what the bond yields are doing. And I don't think many of us in our career have seen the type of market where bond yields have basically gone from negative to 5% within this period of 3 years.
Yeah.
And that's something that changes everything, because you've gone from when everyone was scrambling to try and find a way to make 3-4% and every type of obscure different instruments, to now you can make 5% in a money market instrument. That changes the valuations of everything.
Mhm.
And that's really, I think, what's caused the market to have this dislocation, that banks, utilities, telcos are getting hurt because things you used to buy for dividend yields, you don't need them anymore because of money markets. But if that big yield curve is going to flip, or we have seen a peak in yields, and a recession is certainly one way to get yields to pull back. This is kind of game on in different parts of the market. And that's something that you don't want to get too bearish on, because you can miss some really good returns if you're late. You kind of don't want to wait for the recession or wait for bond yields to have everyone know they've peaked to get in, because by then the part of almost the juiciest part of the trade's done.
Yeah. Yeah. And isn't that the truth, right? Like by the time it makes sense, the market has moved. We've talked about that in positioning strategies. Like we obviously, purpose is an active manager, but also a subset is the creation of ETFs and vehicles to access the marketplace in various fashions. And a lot of times when we make a sector call, we manage a lot of capital. We have to put that exposure on nimbly, cheaply, and liquid, because half the time too, while we're pontificating and trying to have meetings with the various management teams and roll our sleeves up, the market will move 10-15% before you've ever even figured out which person you want to take to the dance, so to speak. Not in closing, I wanted to make sure that we stayed in brevity here. And I think the purpose of this, no pun intended, was really just to have a high caliber person like yourself who we do work with closely and in the formation of ideas and how to implement tactical positions within the portfolio and form the magnetic core of what we're doing. These checks and balances are important. We've talked about interest rates and bond yields. I actually maybe 2 seconds on the interest rate component. Bond yields, I said to a friend of mine who runs a private credit fund, I was like, clients can't eat IRR, they can't eat returns. And it's an argument I used to have with my wife around the difference between gross profit and gross margin, albeit they're same thing, they just speak differently. You're a retail client. What's your view on interest rates? Like, I don't think anyone believes they're going back to zero or low anytime soon, but do you think central banks, will Canada have to cut before the US?
Well, it's going to be an interesting debate. I think Canadians are finding more stress because of where the interest rates are, and that's just because of the way our mortgages are structured. The U.S. and average American has a 30-year mortgage,
lowest in the G7, lowest in the G7,
yeah,
and they're
right.
income tax deductible. So yeah.
Yeah, and there's a lot of people that are already pointing at the stats that I'm going to get the number wrong, but it's 30% of all mortgages in Canada reset in the next 18 months. And that's going to be scary. And I think the central bankers are aware of that number and is pretty high in their statement, because central bankers don't want to break things. And they always usually tend to stay too long, too tight. And I think they're fully aware of this, and they've seen the stress in the system. So I think there's probably going to be some sense that the Bank of Canada is going to have to cut before the Bank of the U.S. FOMC. The Bank of Canada also hiked 6 months before the Fed started to hike. So they were earlier to hike, so they should be earlier to cut. But the biggest implication there is the dollar. Because if the Bank of Canada starts cutting and the U.S. doesn't, or stays higher for longer, the Canadian dollar is going to come under pressure. So the dollar is maybe the collateral damage that they don't want to focus on, but it's something to be aware of, and why you may want to have a little more exposure to the U.S. dollar going forward. Because
let's talk about oil there. Like go to TF. Let's talk about oil. Aside from the geopoliticals, it's constructive on the sector.
Absolutely. I think the one thing that I'm taking away from this is, at the end of the day, ESG is going to go down as the best thing that ever happened to the Canadian energy sector. It's probably a backwards way to look at it. Because of lack of investment
in tight oil supply. Yeah.
Absolutely. We almost had 5 years where there's no capital formation. No one was going to put money into the sector. There were no juniors. There was no exploration. There were no wells being dug. There's no mines being built. And what happened is the companies have made it out the other side, made it through the darkest period, are now incredibly well-run operators, and they're cash flow machines.
And they also seem have you seen balance sheets like this? It's incredible.
When you look at these companies like Tourmaline that are doing buybacks and special dividends, and they're not making stupid acquisitions. And I think this is something that they're suddenly realizing will bring their stock a lot better investors over time. And so I think the energy sector is one you want to hold on. And especially if inflation is going to be sticky and around for a while, you got to have a case for real assets. And I think the real assets are going to be part of everyone's portfolio, and they should be, for maybe a 5-10% weighting going forward. And that's not just energy, that's maybe gold, some copper, some of the other agriculture. And I think these are just good diversifiers and kind of a nice way to have something that's not correlated to one, like we've seen with fixed income.
We've talked uranium before too, and I think like the kind of wanted to give you a little bit of a T-ball there, because again, like geographic biases, you can imagine, like we're a global institution, we've got clients all over the place, but geographically, Calgary's home base, and I spend a quarter of my time in Toronto, but for Alberta-based listeners, we think of energy as oil and gas. Talk to us how to understand uranium. It's something you've steered me, and we do have exposure on across the core fund in uranium, and tell me how that trade plays out and why.
Well, I think there's a few ways that uranium is going to be looked at as almost a green metal going forward. Uranium got the black mark because of, as much as anything, bad press and just a smear campaign after Fukushima and 3 Mile Island and such. But at the end of the day, it's still the most efficient way to plug in your Tesla and get nuclear power to run the grid. The grid's not going to work on traditional technologies. And then I think the biggest wake up for everyone was after the Russian invasion of Ukraine, when Germany, who had been a green leader and ESG friendly, had shut down all their nukes. And suddenly when they started not getting natural gas from Russia, they had nothing to do other than turn on their coal plants. And that's the farthest thing from being ESG friendly. So everyone had that wake up moment, and now they're turning back on nukes. They're building them up. France is going to restart them. Japan, of all places, is going to restart their nukes. And people are suddenly realizing there isn't that much uranium out there, and there are no new mines being built. And I think that's the big wake up. And the good thing with Canada is we do actually have a few good companies here and I think Canadian uranium production is some of the best in the world. Cameco is one of the ways you can get exposure to this. I don't think many people want to buy anything from Russia these days. And then there's also a lot of good the next tier down. Next Gen is a name that we've been heavily involved in, and I think we've talked on before, that has done incredibly good things, and just recently got their permits to build the next big uranium mine in the world in northern Saskatchewan, near to some of the Cameco assets. And
they head office in like Saskatoon, aren't they?
I think their head office is in Vancouver, but certainly have a big Saskatchewan presence. And all
the cool places I do get to travel, I still do get back home. My family has roots there, so geographically disciplined into Saskatchewan.
And it's nice to see that there's some growth in the mining sector in Canada. And as much as we're giving up on some of these sectors, which hopefully we change that attitude.
Yeah, awesome. Listen, I've used a lot of your time. I want to make sure that everyone we keep this short and brief, and hopefully to create more conversations, like for our listeners or private clients and others. If you have any questions or comments at any time, feel free to give a member of MLD a call or shoot me a note. Happy to discuss things offline or more detailed. But again, Greg, thanks so much for coming into the office today. Maybe next time I'll get a studio you can sit beside me. But
thanks, Chad.
Thanks for your time, Greg. Talk soon.
Great. Thanks. Bye.